So welcome to our seminar on the inflation topic. Is a very important topic nowadays and ever increasing with the troubles at the geopolitical level. So I'm joined today by Gillian Verstraeten. So Gillian is leading our data science experts, and Gillian himself, he has a PhD also in the matter and in macroeconomic forecasting. So before we start, let's have a look at our agenda. So first of all, we'll give a very short introduction on our methodology. So we have a leading forecasting methodology based on leading indicators. So more about that in a few minutes. But the main topic of today is how to deal and how to understand the current inflation wave, and more importantly, what can one do about it, or how does one has to understand it within his value chain in his ecosystem of activities. So let's dive now into the leading indicator forecasting topic first. So maybe some of you know that Solventure has developed a leading forecasting service based on a database of 10 million indicators. So we are monitoring worldwide indicators, both in the East and the West, so to speak. So that has to do with everything in the China environment, but also at European level, like with Eurostat or with databases coming from the Fed or from Latin America. So the forecasting we do typically is at tactical level. So it means it is between 3 to 12 months. And we do this by identifying the leading indicators that are specific for your business. So as said, we will today focus on the inflation method, and it will also be a very challenging thing to identify those drivers that affect your business, and then also to better understand how cost-wise and revenue-wise these drivers are impacting the evolution of your business. And together with our, let's say, live system, so leading indicator forecasting engine, and with our experts, we are able to help you in that, let's say, difficult challenge. So if we move to the next one. So what is forecasting with leading indicators? Basically, it is finding those indicators that have predictive value over, as I said before, 3, 6, 12 months. It is external data. So we are matching your internal data with external data, because if it's purely internal data, the system is not really able to forecast certain trends and movements that will happen in the future. We can do that with bringing in these external data. Typically, that is 1 indicator, 2 indicators, can be 5 indicators that we will put into a predictive model. You see at the bottom line here at the right under the lead that we have indicated. So typically there is a predictive power that the external indicator will have on your business. In this case, it's a sales volume, but it could also be a cost driver for better understanding how your overall costs are behaving. So then in the next slide, you will see that this leading indicator forecasting fits within a global concept that we have developed. So on the left-hand side, you see the data that we are monitoring, but also updating every time there is new data available. So as I said before, we have these known databases, public databases from Eurostat or from the US or from China, but also we connect ourselves with specific service providers such as LMC for the automotive market, or ICIS for chemical and energy industry, IHS market, and others. So you might also have yourself external data, and we can perfectly integrate them with our services. And then you can go into several steps with our methodology. It's first, of course, it's about matching what type of indicators are relevant for your business. So we do that by combining intelligent matching also, and that with expert knowledge that either we have at our disposal, but also that we will capture through workshops that we will do together with you and with the business leaders. The next step is building the predictive model or models. We do that by matching these external indicators, so with your internal data, and through a series of iterations, we will find the best model or models to capture the evolutions of your business. And as I said, that is typically on a 3 to 12 or even 18 months horizon. It becomes interesting once we have these models, because then we can do scenario planning, meaning that we can also start to create scenarios regarding these indicators and look even further in the future, and so also support you with the type of evolutions your business might evolve in. So I think I'm not going to wait longer with the topic of inflation. So Gillian, I'll hand over to you, and up to you now to bring us up to speed with this challenging inflation we are currently facing.
Okay, thank you very much, Christophe. So let's first take a look at what inflation exactly is. So I think most of us, if we go to our grandparents, everybody I think has a story or has heard their story about inflation. From my grandparents, it was the story of bread. Bread prices have increased over the years. So they used to tell me that piece of bread or a loaf of bread costed about 10 euro cents. Nowadays, that same type of bread would cost over 2 euros. In the visualization here, you can see the impact of inflation on the price of a cup of coffee. You can see that in 1970, you would pay about 25 cents for a cup of coffee, whereas in 2019, you would pay a lot more for that same type or same cup of coffee. You would pay $1.59 for that. So that means that if we went 50 years back in time, you could buy 6 times the amount of coffee cups for the same money that we used to buy one now. So that's the result of inflation. So what exactly is inflation? Inflation is the rate at which the value of a currency is falling. Another definition could be the general level of prices for goods or services. So that's both definitions. How do we typically measure inflation? Inflation is typically measured by consumer price indices. So central banks, they will determine a certain basket of goods of which they will monitor the prices. So typically those baskets of goods, they are reported with and without very volatile costs. So some of those costs are, for example, energy and food prices. They are more volatile in general than other types of goods and services. We also have 3 types of inflation. So one type of inflation is the demand pull effect. So that occurs when the demand is significantly higher than the supply. This leads to prices increasing and thus leads to inflation. You have cost push effect. So if a specific raw material increases in price, that will also lead to inflation, as resulting goods from that raw material will also increase in price. And then in a certain sense, you also have a bit of built-in inflation in the system when we are producing and printing money. That in general leads to inflation as well. So why is everybody talking about inflation currently? So as I told you before, central banks, they will monitor inflation by looking at consumer price indices. and consumer price indices have increased over the past year quite significantly. So life has become more expensive in general. In February, this inflation or this consumer price index has reached 8%. And as you can see, this is quite a lot above what we have seen in the past 20 years. So in fact, to see similar levels of inflation, we would have to go back to the early 80s, to the great inflation period, where inflation reached more than 15%. What's to be expected with inflation? Well, the Fed typically gives an overview of their expectation of inflation for the next couple of years. And as you can see, in 22, the expected median inflation is still above 4%. So this gives an indication that inflation is expected to stay here this year. So we will need to take measures to take into account that inflation. So that's the story for the US. In the EU, we see a very similar behavior, right? So we see that in January, the consumer price index in the euro area has reached 5.2%. The preliminary numbers for February show also a very large, sizable increase again, 5.8% year on year. So inflation also here seems to be still increasing. And if we look at the breakdown of that 5.8%, we see that the main impact driver of that 5.8% is energy, of course. And we all see prices at the pump increasing and so forth. But the other types of the other components of that consumer price index are also at quite high levels. You see food and alcohol and tobacco above 4%. You see non-energy industrial goods at above 3%. So that's a very large number still. Okay, so we have shown that there is very high inflation, and that the expectation is that inflation is here to stay for the next year. In fact, I don't think most of us in our careers, they have seen similar levels of inflation, as we need to go back 40 years in time to see similar levels of inflation. But why should we bother? Does it really affect my company? Yes or no? And that will become clear in the next slides. So we have different types of impact of inflation on your company. We have the effect of monetary policy. We have the effect of cost increases of various parts, components, and situations. We have an impact on import and export, and we have an impact on margin in the value chain. So let's first look at the effect of monetary policy. So central banks, they have a dual mandate in which they want to both keep employment at a maximum level, and they want to keep inflation at a sizable level. And so both the US Federal Reserve and the Euro's central bank, they both have a target of around 2% inflation. And so, as you have seen in previous slides, the currently inflation is a lot above those levels. But in general, the central banks, they want to keep their inflation near that 2% target because it normally keeps inflation under control. So we avoid stagflation or very high inflation. But they also want to stay away from deflation, as this does negatively impact the economy. Central banks have several tools at their disposal to work on that dual mandate. So they have interest rates, and they have programs of buying or selling several assets. So typically, what is going to happen over the next couple of months, as inflation is too high, And the Fed, for example, has said that employment is reaching its maximum level. Central banks will take measures to slow down economic growth. So they will increase those interest rates. They will reduce their asset buying behavior or even resort to asset selling behavior. And this will have an impact, of course, on your company. Doing those or applying those actions, it will slow down the economy. It will make borrowing money more expensive. So in general, it's not good for growth if central banks take those measures. Next, we go to cost increases. So cost increases. For cost increases, we're looking here at producer price index. So that's in contrary to the consumer price index. It's a measurement of the average movement in selling prices for domestic production over time. So here we see that the producer price of those commodities is reaching a very high level here. We see on year-on-year basis, the increase has been 20%. So a very drastic increase on commodities, which are typically at the start of the value chain. And if you go further into that value chain, you see that the producer price for total manufacturing industries, so that's producer price for the general manufacturing industry, is now exceeding 15%. So a lot of those cost increases are being pushed up in the value chain. So we see here 15%. This is also a very high level compared to historical levels. So it's really an effect which we haven't seen over the past 40 to 45 years. As we have shown at the beginning of the presentation, one of the major parts of that inflation outbreak is due to energy prices. Energy prices, they have increased very drastically. They are also very important for both consumers. We use energy prices to heat our houses, to transport ourselves for work and for leisure. It's also very important for industry, for logistics, for raw materials. Lots of raw materials are linked to oil prices, and for the production of energy, which is used in various industrial sectors. So crude oil prices, they have recovered in 2020 from their pandemic low. I think we all still remember the time in May 2020 when the WTI oil future went strongly negative. Well, as you can see, this the recovery has or the increase in cost prices for oil have reached or have increased dramatically since then, and are now today at over $120 per barrel. So part of that is due to the supply being tight for the demand. The economy is growing at a really strong pace, yet the supply has not grown with the same pace. Also, there is currently, of course, a geopolitical premium on that oil price. A big oil exporter is Russia, so that supply is becoming also uncertain. So that's, of course, gives another push on the price levels. Another indicator in which we can see very high inflation is natural gas prices in Europe. So we see that due to those political tensions and the war between Russia and Ukraine, and low inventories in Europe have pushed natural gas prices to multi-year highs. If you look to the year-on-year increase, we're really seeing price increases of between 5 and 6 times the price we would pay last year. So that's a very drastic price increase also. And this brings us to the next topic, to greenflation. So greenflation is a result of with the economy growing and greener, and the desire to have a greener economy. This leads to higher prices for electricity and a range of metals, and this could potentially be a very structural inflationary effect. So let me dig a little bit deeper into that rationale. So since the COVID pandemic outbreak, the economy has grown at a very fast pace. So this has put a lot of demand on energy, on oil, on electricity, and so on. So this has drastically increased the demand there. However, the electrical capacity, so the energy capacity, remains under strong pressure. And so what we see over the past years, coal plants have closed in Europe and in the US. There's a war ongoing on nuclear power plants also. So this has left us with a lower capacity and a lower supply of energy. Governments have invested a lot of resources in a greener power generation, yet currently this power generation is not sufficient for the requirements. And of course, it's very intermittent also. If there's no sun and if there's no wind, there's very few production of green energy. So that gives a very or that can lead to a very high energy price on the spot market. So for example, if there's no sun or wind, then gas plants get turned on, and of course that's linked to gas prices, so that can become very expensive. Additionally, that high demand for green energy has led to a very high demand for raw materials that are necessary for batteries, for windmills, and for solar panels, and so forth. So this also has created a very strong inflationary environment, which you can see here. So raw materials linked to batteries and so on, they have really strongly increased in price over the past couple of years. And even with the current geopolitical tensions, for example, Russia is responsible for 10% of the global supply of nickel. So that's currently more difficult supply in the world market. So this has led to a very strong reaction on the price of nickel over the past month. So nickel prices have doubled over the past month, breaking or reaching circuit breakers on the London Metal Exchange as a result, so that future trading has been suspended. We're talking about as a continuously inflationary environment. We all have set our goals for reducing the effects of climate change. We're currently at below, we still need a lot of improvement in the situation so that we can reach those goals. So the demand basically for those raw materials will continue to increase over the next couple of years, creating a potential further inflationary environment. Currently, there's also a very geopolitical impact on inflation. So the war of Russia on Ukraine has put a lot of resources out of the market. As you can see, the main export of Russia is energy. So that has, as you could have seen in the previous slides, it's created a strong impact on prices for energy around the world. There's also an impact on raw materials. Nickel is an important export of Russia, and this has had an impact on the nickel market. And furthermore, wheat, corn, and so forth are very important exports of both Ukraine and Russia. And that has led to a very strong increase on corn and wheat prices. So if you're in the food business, that will definitely have an impact on your business in the next couple of months. Both countries are also producers of seed oils. So in Belgium, at least, many of the supermarket chains have limited the sales of those oils, which because it has been impacted by panic buying behavior. So that was kind of the direct impact of the geopolitical part on the inflation. We also expect kind of an indirect impact. So in the sense that there's the supply disruptions of key raw materials, automotive sector could potentially be or will be impacted by certain parts and wiring harnesses for cars, mainly European automotive producers that will be impacted there, which is a key raw material which is mainly sourced from Ukraine, and that might or that will be reduced for the next couple of months. Also, the semiconductor shortage might be impacted by the geopolitical situation, in the sense that Ukraine is a major exporter of neon gas. So there could also be potentially an impact there, but there it's more uncertain. Additionally, a lot of uncertainty also gets added, right? So I've previously talked about panic buying behavior, people stocking up on goods such as oils, or people fearing an all-out nuclear war. That has an impact on panic buying. Additionally, it has reduced economic sentiment. So that's what we're seeing in economic consumer surveys. We see a drastic reduction in consumer sentiment. There's also a big impact on the pent-up demand potentially. So, for example, in automotive, there has been fewer production of cars than the demand has been. So that geopolitical impact can potentially impact the pent-up demand there. And for example, also here in automotive, the focus of companies could go even more onto high margin products. And so in what we saw in the past year on the automotive sector is that the more luxury cars where automotive producers have a better margin in, they have been prioritized over lower margin cars. So that might be the case here also potentially in other sectors due to the geopolitical impact. There's also potentially an impact on employees. So typically when we hit a recession, as you can see, there's a massive amount of layoffs. Companies go into crash protection modes. Typically there's layoffs, there's fewer hires, and then after the recession, it's typically followed by a period of hires. That's what we're currently in. And if you combine that with the high inflation factor, so we see that in the US, there's currently 8% inflation. So if your wage doesn't evolve with 8%, you're actually taking a step back. So this could mean, or the impact of inflation could lead potentially to a lot of employee switching here. With all things happening around the world, we could still forget that there's still the COVID virus going around. COVID has had a drastic impact over the past 2 years, and it will continue to do so. So over the past months, we've seen that due to the Omicron virus outbreak in China, there has been local lockdowns there. For example, in Shenzhen, there has been, which is the main hub in China, there has been a local lockdown over the past weeks. So this could further deteriorate supply chain hurdles. And COVID and also leads to additional shipping durations. And so that's what we're seeing in those shipping rates. Also, typically you can think of it as a kind of a demand-driven market, as the amount of ships is quite fixed for the short term. It takes more than a year to build such a ship. However, then we see that the demand is typically driven by the price. So that's what we see with that Baltic, or those Baltic indices. The Freightos Baltic indexes for containers. So you can see that has risen dramatically. It has gone factor 5 since the outbreak of the pandemic. The impact for bulk goods, as you can see in the Baltic Dry Index, has swung a lot over the past year and is back into an increasing trend. Finally, there's also potentially an impact of driver shortages. Also, the impact could be deteriorated by that geopolitical part, as there might be even fewer truck drivers in Europe than there have been over the past couple of months. We could monitor those supply chain hurdles with a new indicator of the Federal Reserve. An indicator is called the Global Supply Chain Pressure Index, and it basically combines the supply chain components of PMI, being delivery times, the amount of backlogs, and the stocks at companies, with transportation costs. And so those shipping indices, which you saw on the previous slides, and with air freight costs, that can give you an indication of how much supply chains are under pressure. You can see that over the past year, this index has risen dramatically. The index is measured in the standard deviation, so it's very unseen amount of supply chain pressures. But as you can see, the situation has started to ease a little bit over the past months. Inflation might also impact your imports and your exports. Inflation impacts central bank behavior, which impacts the strength of local currencies. So if you have a strong local currency that stimulates imports but reduces your ability to compete for exports, and vice versa, if you have a weaker local currency that stimulates exports but makes imports more expensive. So there could very well also be an impact on your business there. And then finally, we see the impact of inflation. You have to see this really also in the value chain of your company. If your suppliers, for example, have a lot of bargaining power, and your clients also have a lot of bargaining power, we've seen that the input prices, the producer prices of commodities have risen with 20%. So suppliers will attempt to push those cost increases upwards in the value chain or downwards in the value chain. So if your suppliers push price increases up to you, but your clients block those price increases, you might be at the mercy of them, and that can lead to a margin squeeze, where your margins are being squeezed and due to those price increases. So as you can see, the inflation environment has a very strong impact in many aspects of your company. So what can you do about it? Well, we have developed an easy data-driven approach which you can use to monitor and to calculate the impact of inflation on your value chain. So what we propose to do is, first step is to map out your value chain, and then monitor the evolution of demand and production of inventories and of prices along your value chain. So imagine that you're, for example, an automotive player. You're quite upstream in the supply chain, for example. You don't have a lot of feeling with your consumer because it's several steps away in the value chain. Then what we propose you do is you map really how the demand is evolving of those different players in the supply chain or in the value chain. So you can monitor the evolution of sales. Sales is going from the OEM to the consumer. You can monitor the behavior of the assemblies. So assemblies is the direct behavior of the OEM. You can also monitor the industrial production of motor vehicle parts. So that's the behavior of tier 1 suppliers to the automotive. And this will help you to gain insights in how the demand is evolving in your value chain. And typically those drivers, they will have a leading value also on your demands. Furthermore, you could monitor inventory levels. So here we're monitoring the amount of domestic auto inventories, so finished autos in the US. And we're also monitoring the amount of car parts or motor vehicle parts in the US. So you can see that the domestic auto inventories are at an all-time low level. There's very few finished cars in the US, but you can see that a lot of those inventories are being pushed currently to in the value chain to the tier 1s and so forth. As you can see, the total inventories for parts has increased drastically over the course of last year. Lastly, you could also monitor the price levels. So you have consumer prices, you have producer prices, which will all be very interesting to monitor. Here we're monitoring the price of used cars. And as you can see, the consumer price of used cars has increased with over 50% over the past year. So there we also see a very drastic increase, which is due to the fact that there's few supply of new cars. And of course, the supply of those used cars is also quite limited. So you could monitor the price levels of used cars, of new cars, of parts and so forth, all in one dashboard. If you still want to go further, you could include those drivers into a forecast model. Forecast model that takes into account those drivers. Here, as an example, we have a forecast model for the automotive market being driven by vehicle sales and consumer confidence with a leading value of 3 and 5 months respectively. So that could potentially be a next step. So as a wrap up, we have shown in this presentation that inflation has many downside risks for company. So there's a lot of parts of inflation that might impact your company. We propose that you could try to mitigate or quantify that impact by mapping out your value chain and monitoring demand, inventories, prices, and for example, orders in your value chain. And you could potentially also build a forecast model with that data. So If you want to get more information on that, I recommend you to download our ebook. So you can scan that QR code at the top of this page, and you will get a link to the ebook containing a lot more information on leading indicator forecasting. So now I hand the word back to Christophe.
Thank you, Gillian. I think your explanations were very insightful, and one thing is absolutely clear, that is that information is more than ever key in these challenging times, but also understanding indeed how cost drivers are evolving. And it was really insightful also to see that companies will cope in a different way with these challenges. The example you gave about the high margin products, that certain automotive players will be selling more than before, I think is well illustrating how you can deal with shortages and cost pressures and still having a better margin. I had one question from the audience. It was more related to a message this morning by the Bank of England, where they confirmed that on an annual basis the inflation would be 8% in the UK, and somebody was wondering, is this going to stop? Of course, that's a $1 million question, but anyway, I think you may have some insights you may want to share on that.
Yes, thank you very much. It's indeed there's a lot of uncertainty on that estimate. As you have seen in the presentation, the Federal Reserve in the United States expects 22 to have still a lot more inflation than the 2% target level. The expectation currently is 4%, but that's of course with a lot of uncertainty. It might very well be a lot more. So that's where it gets interesting. If you can monitor how all those indicators are evolving, you might get more of a hands-on or a more direct exposure to quantifying that impact.
Okay, thanks. So we will end the webinar. I can only thank the audience for staying with us, and hopefully we have convinced you that it will be paramount to dispose of the right information to deal with the current environment. So if you would have any type of question you might have, Kilian and myself, we are at your disposal. And hopefully we see you next time in our following webinar. Thank you very much.